Welcome to this explainer. If you've been keeping tabs on global accounting standards, you already know that the International Accounting Standards Board just dropped something absolutely massive. We're looking at a sweeping new standard, IFRS 18, that will officially replace IAS 1. To give you some context on just how big of a shift this really is, IAS 1 has been dictating the rules of financial presentation since way back in 1997. So, yeah, this isn't just some minor tweak to the rules. This is a foundational, once-in-a-generation shift designed to bring true, reliable order to financial statements and completely reshape how companies communicate their performance to the public.
But hey, before we look at the solution, we've got to understand the problem, right? Why is comparing financial performance so insanely difficult today? I mean, right now, looking at two companies side by side can literally feel like comparing apples to oranges. Because IAS 1 lacks strict definitions for things like operating profit, companies have basically been left to their own devices. Add to that the explosive rise of rogue non-GAAP measures, where companies essentially get to grade their own homework, and suddenly figuring out the true underlying performance of a business becomes a full-on detective job for investors. The transparency just isn't there.
Okay, let's dive into this. To make sense of all these changes, here's our highly structured roadmap for today's explainer. We'll start by introducing IFRS 18. Then we'll look at structuring the income statement. From there, we'll cover the cash flow statement updates, explore the taming of non-GAAP measures, and finish up with the road to 2027.
Part 1. Introducing IFRS 18.
Think of this new standard as the ultimate regulatory organizational tool for financial communication. Its entire purpose is to improve the effectiveness, transparency, and consistency of how companies report. To really picture this, think of the old standard, IAS 1, like a remarkably messy closet. Because it lacked rigid definitions, companies could kind of just put their expenses wherever they wanted on the shelves. This created totally inconsistent, highly varied definitions of operating profit. Well, IFRS 18 changes all of that. It acts like a professional organizer coming in and building mandatory, standardized shelves. From now on, every single item has a specific, regulated place it must go, creating a beautifully transparent and structured financial statement.
Moving right along to Section 2. Structuring the income statement.
Let's see how this builds into the income statement, which is undeniably the area getting the most significant structural overhaul under these new rules. Remember those mandatory shelves I just mentioned? Well, here they are. IFRS 18 introduces 5 brand new, absolutely mandatory categories. Going forward, all items of income and expense must be classified into one of these specific buckets. First, operating. Second, investing. Third, financing. Fourth, income taxes. And fifth, discontinued operations. It completely removes the guesswork for analysts and investors trying to figure out where a company decided to bury a specific expense.
Now, what's really interesting about this is how these new categories physically change the face of the income statement. Notice the 2 brand new, mandatory subtotals that companies must now present. First, there's a standardized operating profit, and second, right below the investing category, we have profit before financing and income taxes. No more making up your own definition of operating profit, the math is now strictly defined. As IASB Chair Andreas Barco stated regarding these specific changes, this standard will finally provide investors with more transparent and comparable information about a company's financial performance.
And why this matters should be crystal clear. We're talking about true comparability for investors. By standardizing these subtotals and enforcing strict categories, the standard absolutely stops companies from hiding operational costs in obscure line items. You can finally take the income statements of 2 competing companies, look at their operating profit, and know exactly what you are comparing.
All right, Section 3, Cash Flow Statement Updates.
Of course, you can't make a change this massive without it rippling out, right? So let's look at the knock-on effects IFRS 18 has on other standards, specifically IAS 7 regarding cash flows. This explicitly illustrates exactly what we mean when we say IFRS 18 removes accounting policy choices. Previously, companies had an accounting policy choice on where to classify interest and dividend inflows. They could be operating or investing. Outflows could be operating or financing. Under IFRS 18, that choice is entirely gone. Interest and dividend inflows are now strictly categorized as investing activities. Outflows are strictly financing activities. Furthermore, the mandatory starting point for the indirect method is now specifically operating profit or loss.
Once again, we ask, why does this matter? Well, because it eliminates the guessing game of cash flow classification. Strict categorization for interest and dividends ensures uniform cash flow statements across the board. You don't have to go digging through a company's accounting policies just to understand how they decided to classify their bank interest this year.
Which brings us to Section 4, Taming Non-GAAP Measures.
Now, let's shift our focus away from the primary statements and look at the notes, specifically the crackdown on inconsistent alternative performance metrics. IFRS 18 introduces a highly important new concept, management-defined performance measures, or MPMs. To de-jargonize this a bit, these are just the subtotals used in public communications outside the financial statements that reflect management's view of performance. We're talking about those highly customized figures companies just love to promote. Things like EBITDA, or the ever-popular adjusted profit, excluding all the bad things that happened this quarter.
Now, IFRS 18 doesn't ban these measures, but it sure does force them into the light with some really stringent new disclosure requirements. If a public company uses an MPM, they must now include a note meeting several strict conditions. First, they have to explicitly detail how the MPM is calculated. Second, provide a clear reconciliation to the most comparable IFRS subtotal. Third, explain the purpose and why management thinks it provides useful insight. Fourth, disclose the income tax effect and the non-controlling interest impact for each reconciling item. And finally, they have to include a statement clarifying that this MPM might not actually be comparable to similar measures used by other companies.
So, the crucial point is this. Management can still tell their own unique story about their financial performance, but they must now rigorously prove the math behind it. This matters because it completely unmasks those adjusted figures and mathematically connects them directly back to the reality of the audited IFRS numbers.
Finally, Section 5, the road to 2027.
This brings us to practical application. When does all of this happen, and what do financial professionals need to do next? IFRS 18 becomes officially effective on January 1, 2027. Now, 2027 might sound like it's far away, but look closely at the middle of this timeline. In the year of adoption, companies are required to provide a restatement of comparative periods. That means you'll need a reconciliation between the old IAS 1 comparatives and the new IFRS 18 presentation. To pull that off, the work to assess data systems and map out your new shelves really has to start today, long before that 2027 deadline.
Ultimately, IFRS 18 was built to solve a systemic problem in financial communication. By enforcing mandatory categories, creating strict subtotals, and demanding rigorous proof for management-defined metrics, this standard brings order to the chaos. It achieves the ultimate goals of financial reporting: consistency, transparency, comparability.
Which leaves us with one final, very practical thought to ponder. Knowing that the comparative periods will need to be perfectly restated under these strict new rules, are your data systems prepared to categorize every single expense for that 2027 restatement? The rules have changed, the shelves have been built, and preparation absolutely must begin immediately. Thank you so much for joining me for this explainer. Now go take a look at your own reporting systems, and I'll catch you next time.